A very good morning. Hello and welcome to Morning Trade with Moneycontrol. I'm Stacey Pereira, filling in for my colleague Nandita Khemka, and I'm here to help you navigate this trading day with the actionable trading strategies, sectoral trends, and most importantly, your queries during the course of this show. So guys, keep commenting on our live feed and we'll have it addressed by our guest on the show. But before bringing him on board, let me take you through all the global handover and what we can expect in today's trading day in the headlines. US stocks rally ahead of key macro data and the policy that is expected this week. The S&P 500 gains for the fourth straight week, the Nasdaq for the seventh, as the street bets that the Fed will finally pause on rate hikes at this week's meeting. Stocks in Asia Pacific open mixed this morning while the SGX Nifty is signaling a higher start for the Indian markets. And Moody sees India's GDP growing at 6 to 6.3% in the June quarter, lower than the expected 8% projected by the RBI last week. The agency also flags risk of fiscal slippages on weaker than expected government revenue. And venture capital firm Sequoia Capital will sell up to 10.18% stake, which holds in Go Fashion, the parent entity of the Indian clothing brand Go Colors, via block deals. The floor price for the stake sale will be at around 1,135 per share, which is at a discount of 5%. The move comes just days after the Co splits its business into 3 entities. And Titagarch Wagons board approves a proposal of raising up to 288 crore rupees via preferential lot allotment of shares to the Small Cap World Fund Inc. The nod for issuance of up to 76 lakh shares to the Capital Group company, subject to approval. And a Reuters poll sees India's CPI inflation for May coming in at a 20-month low of 4.42%, close to the RBI's 4% aim, as a rise in food prices is likely to ease. So we have all that to discuss. Definitely the May CPI data is going to be a focus. We've seen some really great macro indicators so far. So let's discuss all of that and the impact it is going to have on the Indian stock markets. To do that, joining me is Karan Taurani, the Senior Vice President and Research Analyst at Elara Capital. Let's get a sense of what the fundamental triggers could be for the market at this current juncture. Let's also take a deep dive into QSR stocks because we are seeing quite a buzz there. Just recently, brokerage firm Jefferies believes that there's going to be a rebound, but that can be expected only in the second half of FY24. So, Karan, what is your quick estimate? Is QSR, is that industry seeing muted demand as of the Q4 of FY23? And when is that going to turn around? We've seen quite a bit of weak earnings from most of these companies. What is your sense?
Hi, morning. So I think if you look at the QSR companies, the performance has been subdued over the last 2 quarters. In fact, even the festive was not that great, in terms of the growth trajectory. And I think we have largely bottomed out now as far as growth is concerned. But we don't expect momentum to pick up, before H2. I think Q1, Q2 will also be one of those muted growth quarters because we've already seen the declining trajectory as far as some categories of QSR are concerned, specifically around pizza, which has been an underperformer versus the fried chicken, category, which is kind of outperformed. And even the burger category that way, has outperformed. So 2-3 varied reasons for this. I think one is, companies that have invested into menu innovation. I think they have done well. Companies that have invested around, new stores, experience of the future kind of stores, have done well, typically on the SSG growth front. So I think from a demand standpoint, bottoming out is done, but momentum, I think, is still some time away. And if you saw last quarter, I think we saw a sharp decline in SSG for most of the companies. It was in the range of about 3 to 5% odd. And if you look at the margins as well, even they were subdued because clearly, price hikes were taken, demand is subdued, and inflationary issues also persisted. So on a margin standpoint and on a growth standpoint, the bottoming out is done. But momentum will take, some time away. I think as we see inflation cool off, demand will pick up, frequency will pick up. And I think those are things which are going to help the overall growth of the industry.
Absolutely, Karan. You in fact just mentioned that there's quite a bit of decline that we're seeing in the same store sales growth. That you could, in fact, even addition has been quite muted. But in certain categories, we've seen the burger format saw strong growth, as well as the companies expecting that momentum to continue. In fact, if we go by ICRA's projection, about 20 to 25% growth is what they're expecting in FY24. Is that possible? Do you think we're going to see that much, or there's going to be other challenges as well?
So I think in terms of growth, as I mentioned, companies like Devyani and Westlife really stand out here. There is a twofold growth trajectory here. One is, of course, around the SSG growth being faster versus peers, and the reason for that is again because one is, of course, the category seems to be underpenetrated. The category is just picking up into newer markets. Second thing is also around the delivery part. So if you look at most of these companies, I think. In terms of delivery share or in terms of delivery contribution, they are still at around 32 to 35%. And if you look at these companies, there's a potential for that number to move up to 38, 40%. Because if you look at the pizza chains, typically they are at somewhere close to 60% delivery revenue. So I don't foresee fried chicken and burger to expand to that number, but maybe around 38, 40% is, where they could peak out. So there is potential around the SSG growth there. In terms of the overall growth also, I think, a total growth of 25% doesn't seem to be, impossible because clearly there is strong store growth as well. So I think except for Westlife, if you look at the other companies, typically Devyani and Sapphire, on their low base, they have been doing a store growth of 25 to 30%. And if you exclude that, on this respectable base in the coming year in FY24 and 25, they could easily do a store growth of at least 15-20%. And if you add back some SSG growth of 5%, I think 25% growth is largely doable. So I think it's going to be a very selective approach wherein there are certain QSR companies because of high store growth, Philip, they're going to do well. And also second reason SSG wise also they're going to do well because the category is underpenetrated because they've invested in terms of menu innovation. And those are going to be some of the drivers around that.
Right. So, but one of the main drivers, at least what markets are also watching out for today, is that domestic inflation data, which RBI hopes that it will come within those within that range that it has been projecting. But the market is hopeful that May will further moderate to about that 4.7% levels. Is that where you are also pegging that inflation number at?
Yeah, I think definitely inflation cool off is something which is happening on a consistent basis, and I think this is only going to intensify in H2. So I think there's going to be a clear correlation in terms of the EBITDA or the earnings growth of these companies, versus inflation, because I think last year they were hit by two reasons. One is, of course, the demand not picking up as per expectations, and also inflationary pressures, which led to price hikes, and that further kind of had a negative impact in terms of overall demand. So I think this year, that way, we are relatively better placed. If the demand momentum actually picks up and the inflation continues to trend downwards, you will see a positive uptick in terms of the EBITDA margin. So I think even from EBITDA margin standpoint, the bottoming out is largely done. So if you look at the larger players like Jubilant, I think they've lost out close to 300, 350 bips on EBITDA margin front over the last 1 year. And that's primarily been because of cheese prices being higher and, them having a higher exposure towards cheese because other players are more exposed to, chicken and other feed, flour, other kind of categories which are there. So I think from margin standpoint, if there is a positive surprise, I think you could see an upgrade of almost about, 8 to 10% on all of these companies, which means that will turn out to be a potential upside. But these triggers have to still play out. So the growth momentum in H2, the inflation cooling off, the positive impact on margins, have to play out for the stocks to move up. Because from a current standpoint, if you see the valuations are not cheap. So I think most of these companies are now trading at a PE range of almost 50 to 55 times FY25. So there's not much to offer there at these growth rates of 3, 4, 5% SSG. But once you see a revival in terms of growth rate, once you see a positive trajectory in terms of sharper margin improvement, I think valuation re-rating will also come by. So I think a good amount of momentum in these stocks, but I think we'll have to wait for a couple of months more to see where the trend is moving towards.
Karan, speaking of triggers, we also, there are about roughly 70% chances, they say, of the El Nino forming. Is that going to make any big impact, especially for these kind of stocks that are really dependent on all of these factors?
Yes, absolutely. I think that could also, see an impact. So last year we saw that, cheese prices were inflated, and this year if the El Nino were to come in, wheat is a very big component for most of these players. So wheat, flour, contribute somewhere close to 20 to 30% of the cost of goods for most of these companies. So I think if that were to happen, if there's some, unexpected pressure around wheat, that could have a negative impact in terms of overall margin inflation because if other things cool off and it wheat or other products, the vegetables, all the other things actually go up, there's going to be a negative impact for sure. So as I said, it's just too early to really drive some re-rating or drive some momentum in the share prices because the prices for all these companies have moved up in the range of 10 to 15% over the last 3 months. And this is factoring in more or less, the growth momentum pickup and the inflationary pressure cool off, which is there. But the further re-rating, as I said, will only happen in terms of how things pan out.
Karan, let me also get your view on new age tech stocks. We've seen Paytm, on a roll. Zomato also was up 2% in the last session. Nykaa too, gaining over 2%. So has the tide really turned for new age tech stocks, and should one be really looking at them at this point?
Yes, of course. I think if you look at most of these new age stocks, I think they're trading at very dismal valuations. And specifically, I think if you look at Zomato, we were recommending that at a price of 50 rupees, when the valuations had actually come on par with some of the traditional QSR names. And what has happened with Zomato is that the growth rates have actually come down to about 15 to 17 odd percent as compared to 25-30% GOV growth rate earlier. But I think the execution on the profitability has been phenomenally good. So if you look at the overall EBITDA margin, I think they're somewhere break even as a percentage of GOV. And they are on their path to get that 4 to 5% adjusted EBITDA as a percentage of GOV as per their guidance. But I think at current price, I think Zomato is now trading at reasonable amount of valuations. We don't see a big upside. I think the core food business is somewhere close to 40 to 45 times EV EBITDA, and that is now at a premium as compared to traditional QSR companies. Now, going ahead in terms of Zomato, I think the levers are quite limited. I think take rate is the only lever which they have to really, push the restaurants to increase their take rates. And if restaurants, don't comply to increase take rates, they have to, kind of increase the prices of the food in terms of what they offer in terms of delivery, and that has an impact in demand because customer is always price sensitive. So I think from here on the valuations or re-rating is going to be a challenge because the quick commerce is also like an overhang because I think that business is also making hefty losses for now with very little recall, because other larger players have got a higher market share therein. Secondly, I think on Nykaa, that looks like a compelling bet at these valuations. So I think from a growth standpoint, FY24, we will see growth rates in the range of 25 to 27%. Tira has come up, competition has always come up for Nykaa, but Nykaa has always maintained their moat, their cloud within the premium customer base. And there's a consistent improvement in margin as well. So I think EBITDA margins for Nykaa are somewhere close to 11 to 11.5% roughly. And there is a trajectory or there are levers for this margin to go to 14%. So I think the core BPC segment today for Nykaa is trading at somewhere close to 40 times EV EBITDA. I think there's a potential re-rating out there. And if there is some trend of fashion losses actually coming down sharply, you could see a big re-rating on Nykaa as well. So I think Nykaa looks to be more compelling as compared to Zomato at these valuations because I think Zomato valuations have actually moved up by 40% over the last 2 months.
Right, Karan, and I know it is a Monday morning, but I wouldn't want to let you go without asking you about Adi Purush. The advance bookings have opened across India, and we are seeing massive, at least 10,000 tickets already sold at just the start of the week. Is this film going to be a changer, or that dismal run in Bollywood? Is it going to turn around with this one?
Yes, absolutely. I think high hopes on Adi Purush because in the last 2 months, apart from Kerala story, we haven't seen any strong content as far as Hindi is concerned. This is one of the larger Hindi films rather in terms of budget, and this has a very mass appeal because this is going to have a strong opening in the regional market as well. So I think, the trade, and we are also expecting a very strong opening for this movie. And in terms of lifetime numbers, it will definitely be higher than the other averages. But apparently, we don't expect this to break records around KGF2 and RRR. I think this will definitely be one of the films which will be higher in terms of collections, but don't expect any record-breaking performance because I think what happens here is that the content is key. And if you look at the runtime of the film, it's about 3 hours. And generally, films which are more than 2.5 hours, generally don't tend to do well in terms of box office in large numbers. But again, it all depends on word of mouth, reviews, and content. Opening definitely will be a blockbuster opening, but whether it sustains, I think that is the question mark.
Well, thanks much for that, Karan Taurani, with all of his views from New Age tech stocks to also the movies that we can catch up on this weekend. Thank you so much, Karan, for giving us your time. But let's also look at what brokerages are talking about. And well, we do have a brokerage report on life insurance companies where Macquarie has downgraded the stocks like HDFC Life, ICICI Prudential, as well as SBI Life from outperformance to neutral. Now, it has also cut the FY25 value for new businesses, so VNB, by about 2 to 6%, and cutting the target price for each of these stocks, where HDFC Life's target has been cut from 556 to which was earlier at 655 per share, whereas ICICI by Prudential, that target has been cut to 486 from 580 per share earlier, whereas SBI Life, that target cut from 1,306 from the 1,580 per share earlier. Now, the brokerage firm does feel that the near-term catalyst is what is missing out, and unless there's growth that picks up meaningfully, this sector is likely to see a performance lag. So that was Macquarie's report on life insurance companies. But let me also now bring on board Rajesh Palviya from Axis Securities. Let's get to understand the technical bits of what we can understand from markets today, and how one should really be looking at the chart in today's trade. Thank you so much, Rajesh, for joining us, and also we'll get all of your viewer queries answered by Rajesh. But Rajesh, let me start by asking you, we've seen a significant upside in the equities, but is that likely to continue? We did see 2 sessions of where the benchmarks came under pressure. So what is that momentum really looking like? Where are the support and resistance levels one can watch out for?
Yeah, good morning. So in the last week, we have seen both the indices were like muted, and range-bound consolidation activity was there for both the indices, Nifty and Bank Nifty. Both have displayed some bit of profit booking at a higher level. But still, if we look at the overall setup for Nifty, it's in bullish territory as we are comfortably holding 18,500. That is the major put-based area for the Nifty. And even in the previous session also, when market was, showing some bit of selling pressure, the put writers were very much intact at 18,500, 18,400 strike, which clearly shows that the market is having confidence that if market continues to hold above for 18,500, then possibly we may see a stock specific action, which we are witnessing from the mid cap as well as from the small cap. So that sector is likely to perform in current week also. Looking at the setup, we do believe that once Nifty manages to cross above 18,700, 750 zone, then this rally can extend further also, and we may have a new all-time high also in the continuation of this uptrend. So buy on dip should be your strategy. 18,450 should be your stop losses at this current juncture. Till we are holding this level, one can remain on the long side of trade. Even on the Bank Nifty, 44,000, we are almost trading near to 44,000 level. As Bank Nifty is having major important support area at 43,800, 43,700. So till these levels are intact, there is no as such worry in terms of banking as well as in the financial space. Both the sector like banking financial is showing good buying traction. Most of the large cap banking stocks are also showing good buying interest in the decline. So we do believe once Bank Nifty crosses above 44,200, then one round of short covering we can expect in Bank Nifty, and further on the higher side 44,500, 44,600 could be the immediate target we can expect in the Bank Nifty. So both the indices are in bullish territory. Buy on dip should be your strategy at this moment.
Right. I think, Rajesh, a lot of people are quite interested there in the banking and financial space, because a lot of queries that are coming in are asking for the views on the Bank Nifty, even asking for whether Axis Bank should be considered. Vasudevan is asking about Axis Bank, as well as Chandu is asking whether Axis Bank should be looked at the up or down trend.
So I'm sorry to say, as Axis Bank is our parent company, so I can't comment on Axis Bank. But overall, as I mentioned about the banking sector, we do believe that banking sector is in a very sweet spot at this moment, and most of the large cap banks are showing good traction. So we expect, whole banking sector is likely to perform. I cannot comment on Axis Bank, so I'm sorry to say for that.
No worries, right? But what about, we're also getting queries on CMS Info. Now, we did see that stock come under quite a bit of pressure, the promoter selling stake. What would be your take on CMS Info stock?
We have seen recovery since last couple of weeks, but in the last week, some profit taking was there in CMS Info. But looking at the overall setup, we believe that if stock manages to hold above 300 level, then possibly some pullback action we can expect in the stock. As the stock is almost trading near to its 50 to 100-day moving average, so 300 is very important level to watch for in today's session. If stocks hold that level, then possibly some pullback can be there in the stock prices. Near-term target on the higher side is around 325 to 335. 335 is the crucial level on the higher side. Once the stock crosses about that level, then these rally can extend towards 360 also. So keep your stop losses around 300 and hold your position.
Right. Rajesh, do stay with us. Let's quickly take a look at other stocks that are going to be a buzz today. TVS Motors is one of them because there were quite a few announcements that came over the weekend. Firstly, the Singapore arm is going to acquire the additional 25% stake in SEMG. Remember, that's that Swiss e-mobility group, which it had acquired about 75% stake in Jan last year. Now, this will be bought at about 517 Swiss francs per share, which roughly converts to 47,232 rupees per share. Now, post the transaction, SEMG will become a wholly owned subsidiary of TVS Motors. And well, in other news that came from the TVS group, where TVS Credit is likely to issue 1.52 crore CCP shares to PI Opportunities, and this for an investment of 480 crore rupees. Now, PI Opportunities will also acquire certain shares in TVS Credit for 257 crore rupees, whereas right now PI will hold approximately 9.72% stake in TVS Credit post the completion of this transaction. And as we know, TVS Motors is the one that currently holds about 85.63% of that paid up share capital in TVS Credit. So that is something that is going to be in the spotlight, but also a couple of other shares if you have to look at, and queries that were coming in also on Indigo. Now, Indigo, that one is going to be a buzz because the low-cost carrier has expanded its code share partnership with Turkish Airlines, and this is for travel towards the United States. Now, the launch of this code share flights into 4 different cities into the United States, that will be via Istanbul and will happen from June 15. Now, the flights will connect New York, Boston, Chicago, as well as Washington is what we're given to understand, and which is why that stock is likely going to be in focus today. Let me bring in Rajesh once again to give us his sense of how should one be looking at this. Aviation has always been, in that whether you should be looking at or not, but some good news, positive news coming in there for Indigo. How should one be looking at this one?
The overall structure for Indigo is looking bullish, and series of higher top, higher bottom formation is there. Looking at the daily weekly setup, stock manages to view breakout of its multiple supply zone, which was at around 2340 level. So if stock continues to hold about 2340 level on a positional basis, then possibly the upside target for Indigo is around 2600 to 2650 on the higher side. But for trading perspective, one can keep a stop loss of 2420 to hold their long position. And looking at the near term, short term setup, we do believe that furthermore upside we can expect in the near term, and 2540 to 2550 could be the immediate target for Indigo on the higher side.
Right, Rajesh, one last query on Indian hotels and what should be the target price that one should look at there.
So overall long-term setup for Indian hotel is bullish. Yes, some profit taking was there in last week, but looking at the overall setup, one can hold the stock, and long-term target we are projecting around 450 to 460. Your stop losses should be around 368.
Well, that was the word on Indian hotels. But it seems like we're completely run out of time. But thank you so much, Rajesh, Palviya, for giving us and answering all of our queries. And for those whose queries are not answered, please do keep coming back to us, because that's what we do right here on the show, is answer your queries. But that's all the time we have on this edition of Morning Trade. Well, we have a lot more lined up. Do stay tuned to Money Control.